Director Loan Accounts, understanding your personal exposure. Welcome to IO Insolvency Options with Darren Vardy, the Managing Director of Insolvency Options and a registered liquidator with over 30 years of experience helping businesses and individuals navigate financial challenges. In today's episode, Darren explains the hidden risks of director loan accounts and how accumulated drawings can create significant personal liability during insolvency. He reveals why many business owners don't understand their financial position until it's too late and shares practical strategies for managing director loans to protect yourself and your family. You'll learn about Division 7A requirements, repayment obligations, and liquidation, as well as warning signs that accountants and business owners should watch for. I'm your co-host Anthony Pearl. Let's dive into unlocking more about insolvency options. Well, Darren, hello and welcome to another episode of the podcast. And we have a very interesting topic, I think, today, because really is a situation, and we were talking a little bit about it before we started recording, about the fact that so many businesses and business owners don't really understand their financial situation and their finances in particular and what they're doing. And the implications of that can be huge if things start going south.
Yes, there are. Quite often we find that people are really good operators, and at the end of the year when the accountants prepare their financials, they go into their accountants will sit and explain the numbers, and they'll sign the financials and tax returns and then move on to the next year. But we're often finding that business owners don't really know what the financials mean other than to whether they've made a profit or a loss. And quite often there are some little skeletons in those financials that can bring business owners undone in the event of a liquidation or an external administration.
Yeah, and I think that's a huge implication, isn't it, for people? I think that's the thing, isn't it? That you're going in there thinking, oh, yes, the accountants know what they're talking about and that's all fine. But the implications of what you might have been doing may not necessarily be at the forefront of the accountant's mind and telling you about it and understanding what that could possibly mean.
Yeah, this is so. Accountants and business owners alike are always looking at the operations of the business. They're looking at how the business is going to survive or work through any financial issues that they have. But very rarely do they actually think about, well, what happens if the company becomes insolvent and an external administrator actually needs to be appointed? And we find that that's where life can get really difficult for these director shareholders, particularly in circumstances where there may have been an accumulated loan account over a period of time for which they've taken as drawings. And when that loan account accumulates, what we quite often find is that as a liquidator or an external administrator, we need to call in that loan account, and the directors and or shareholders find that quite often they're on the receiving end of a formal demand for repayment.
And that can cause a huge problem, can't it? Because if they need to repay it, where are they repaying it from?
This is the big thing. And, quite often, one of the reasons why businesses fail is lack of capital. So if the directors or shareholders don't have the wherewithal to repay, then worst case scenario is that they could end up filing for bankruptcy. Now, we understand during a business life cycle, things get tight. Cash flow gets tight for one reason or another. And there's some very good reasons why these directors would choose to take drawings as opposed to wages through the single touch payroll system and the like. And quite often they're guided by their accountants as to the best way to run their business and draw their money in the moment. And it's okay to take drawings. And quite often what happens is that at the end of the financial year, an accountant generally will convert those drawings to a formal dividend for which the shareholder will pay tax in their own right. The accountant may even convert some of those drawings to director's fees. Again, a director will account for the tax in their own personal right. But when faced with not making profits, ongoing trading losses, directors are unable to take those funds as a distribution of profit because there is no profit. The converting those funds to a director's fee, we'll quite often see trading losses become further exacerbated. So what happens is that we've found is that the accumulation of those loans will simply accrue year on year. And that then leads to the increased exposure of the directors and shareholders for those loan monies in the event of an insolvency situation.
And paint the picture, I guess you've seen this a few times before, that this situation is that the business is probably flying along, doing okay. And so these things that they've been doing in terms of drawings have happened. And then for whatever reason, things start going south and nobody's stopped to kind of work out that this is going to be a problem. And when they do find themselves in this situation, you don't want to be going towards bankruptcy and you don't want to start eating into personal finances as well. But that's the reality, isn't it?
Reality of it is the funds need to be repaid. And the majority of circumstances I've seen of late in recent years is that the Division 7A paperwork is in place. So the loans are all signed off, legitimate interest is being paid back on an annual basis for the funds taking out. However, the real issue is the insolvency event. Upon the appointment of a liquidator, the funds are repayable immediately, irrespective of the number of years those Division 7A loan accounts are in force, which is generally 7 years or 21 years if security is provided. So it also changes the dynamic of when the funds are in fact repayable. So a director or shareholder might be sitting there saying, well, look, that's fine. I have my paperwork in order. I'm repaying the interest as I'm meant to every year, and I'm paying down the loan account as required by the loan. But it's that immediately repayable position that is faced upon external administration, which can come at a bit of a shock to the directors and shareholders also.
Yeah, I mean, what happens in that situation for someone if they're suddenly having to repay a sizable loan and they've got to do it immediately?
So as a practitioner, after we issue the demand, what we often find is that the directors and shareholders will then need to look toward borrowing funds personally. If they've got equity in property, they may need to go back to the bank to borrow the money to repay. But it's really hard to borrow money when you have a strike against your name, having been a director of a company that's gone into liquidation. So sometimes a little bit of pre-planning might be required to say, well, hey, I have this loan, liquidation is looming, we need to repay it. Maybe we need to get our personal financials in order so that we can repay it as and when we put the company into liquidation, because it's so much harder to borrow money, if at all, once the company goes into external administration. So you might actually find that some director shareholders are forced to sell their home to actually repay the loan account.
And that's a huge thing. But of course, that also doesn't happen quickly. So if you are being forced to pay back, I mean, how much leeway is there? Because we all know that selling a home doesn't happen in 30 seconds.
Sure. And this is where we get down to, the practicalities of the process. Most insolvency practitioners, I'd like to think, are commercial. And if there is the intent of the directors and shareholders to sell the home, what we quite often find is that there will probably be an allowance so long as there is the sale within a reasonable period of time. And it might be that the practitioner will request some form of security over the property, such as a KDET or the like, just to better secure their position to ensure that when the house does get sold, they get paid immediately at settlement to discharge that debt. There are many different options available, and that's up for discussion with the independent practitioner.
So let's go back a little bit, because one of the things that you said there that I think is a key is about pre-planning and understanding that you might be going down that pathway. Is that something in your experience that many, both accountants and business owners, think enough about?
It's the old adage of you don't know what you don't know. So for myself, it's a matter of educating the accountants so they understand the implications of insolvency. And therefore, if with one of their clients, they're faced with this situation, they can properly and appropriately advise their clients what they need to do prior to actually initiating the appointment of a liquidator or an external administrator.
And I guess that's about courage as well, isn't it, from an accountant, and being able to talk frankly to a client and saying, look, we don't want you to go down this path. We don't want you to be here, but this is a possibility and we need to plan for the possibility just in case so you don't find yourself in a worse situation.
Absolutely. And what we're finding is that with the advent of business advisory, a lot of accountants who do focus on that are starting to understand and do understand the implications and are happy to advise their clients accordingly.
It is a hard conversation to have, right? And that's saying someone, look, there's a great possibility here that your business is not going to pick up as you might think. And even though we want to be positive here, you have to look at what the implications are and understand it and get them mapped out.
Correct. And, it's the role of the proactive accountant, in my view. The accountant is at the front line generally. They're generally seeing the numbers, minimum or maximum, I should say, on a quarterly basis. So they will know and they will be able to see how the business is going. And it's a matter of putting their hand up and really raising the issues that they see with their clients to allow them to pivot and look at the real issues and try and establish a turnaround. And if not, plan for the worst.
And I guess what sort of businesses are we talking about here that you tend to see fall into this trap a fair bit? I mean, is it because they've got teams, they've got lots of things that they're renting or having to purchase in advance? Are there some key kinds of businesses where this is a red flag of a possibility?
There's no particular industry or size of business that we see this in, but typically what we do see is businesses whose cash flow is strained. We quite often find that they are small to micro businesses. And whilst we have the small business restructure regime in place, my experience is that unless as part of the restructure plan, the repayment of those loan accounts are going to occur in a reasonable period, creditors are less inclined to vote in favour of those restructure plans.
Just talk to me a little bit about that option there that's for small businesses that is available.
So a small business restructure is effectively available for any business, any company which has less than $1 million in overall debt, contingent or otherwise, and it allows the business owner to put a plan to creditors to repay the debts that they owe in full or in part over a period of up to 3 years. Now, to avail yourself of a small business restructure, you must have your financials and lodgements up to date. Your superannuation and any SGC applicable must be up to date, and you mustn't have gone through any type of SBR process in the last 7 years. The beauty about the eligibility criteria is that the financials are reliable when you're looking at them because of the lodgements being up to date. So therefore, when it comes to creating the plan, working out what needs to be done, it is a lot easier to determine the best outcome for all creditors based on a better known financial position.
I mean, just to wrap this part of the discussion up, Darren, I mean, what are some of the warning signs, both for a business owner and also for an accountant to be looking out for to say, well, we've got to start preparing just in case?
I think the easiest sign to look at in this day and age is just the ever accruing tax debt. If the tax debt is starting to creep up month by month, quarter by quarter, and there's no real indent being made by money's being repaid, that's a fairly simple key indicator for both accountants and their clients. Then you've got other indicators from a business perspective, like, your accounts receivable not being paid in a timely manner, leading to cash flow issues, which then leads to your accounts payable starting to slowly drag out the number of days upon which you're being able to pay them.
I think there's some good lessons there. And I think, again, as you said earlier, accountants being proactive, but also business leaders being realistic is a huge lesson to learn from all of this.
Yes, that is correct.
And that's all we have time for in this episode of IO Insolvency Options. But in our next episode, we'll explore business financing and making smart borrowing decisions. Darren will reveal the hidden dangers of high-interest fintech loans and why borrowing to pay old debts without addressing root causes only delays the inevitable. It's an episode that could save your business thousands in unnecessary interest costs. If you need expert guidance on insolvency matters, contact Darren Vardy and his team directly at insolvencyoptions.com.au or call 1800 463 328, or you can connect with Darren on LinkedIn. Details in the show notes below. This episode was produced by my team at podcastdoneforyou.com.au, helping professionals share their expertise through powerful podcast content. If you found today's episode valuable, please like, comment, and subscribe to IO Insolvency Options so you never miss an episode. Until next time, remember, there's always a way forward when you know your options.